Everyone has the longest standing private equity debt capital markets team, and it's been in place since 2005. It's developed into an integral part of our active asset management approach, and it is housed with pure debt professionals who have over 70 years of aggregate experience. We work closely with our private equity business and portfolio companies globally in managing the lending relationships and interactions. And we're involved at all stages of a life cycle of a private equity investment. Our interaction commences when we're assessing a new opportunity, and we start with the debt capacity that best meets the profile of the business. We then try to isolate the right lenders to progress through the journey and then negotiate the optimal terms that will enable us to meet the investment thesis and our objectives. As we work through the life cycle of an investment, we work extremely closely with the management teams and the wider deal teams on day-to-day requirements that can relate to working capital, asset management, and all the hedging needs they may have. And of course, when we're hitting real event-related financings, we work extremely closely on buy and builds for new acquisitions, amendments and extension of facilities, wider refinancings, and recapitalizations. Finally, at exit, we ensure the business has the right support from the debt market to ensure that underpins its next phase of its journey. Recent deal examples include a new acquisition financing for our investment in water wipes, where the key aim was to structure a debt facility that underpinned its growth ambitions. In addition, we did an incremental term loan financing for our business in Germany called Mate, and that allows the business to continue its buy and build aims. Finally, I'd reference one of the largest euro term loan refinancings in the market last year for our investment in Action, which both extended maturities of the current debt facilities and also achieved a material saving in its annual interest costs. Now, transaction structures are going to differ depending on the specific details of the company. However, if we were to take a step back on the portfolio, we would see prudently leveraged structures on an all-senior basis, good maturity profiles from a diversified set of lenders, which is well hedged to withstand any changes that come. That is our approach.